As the Nigerian equities market kicked off 2025 on a bullish note, the all-share index surged 1.52%, closing January at 104,496.12. Well, joining me for more on this, I have with me Oluboboye, lead economist and fixed income strategist at Cardinal Stone Partners. Thank you so much for joining me today.
Good morning, and thank you for having me. It's great to be here. Happy New Year.
Happy New Year to you too. And happy birthday in arrears. All right, so let's.
I really appreciate it.
Let's get back to business. The all-share index closed January at 104,496.12. It's gained 1.52, just like I said earlier. And the market capitalization grew from 63 trillion to 64.7 trillion. Talk to us, how significant is this increase in terms of investor sentiment and market liquidity? Mr. Boboye, if you can hear me, I'd like you to just go on ahead.
Hello, can you hear me?
Absolutely. Do go ahead, please.
Great. So I said that one of the things that we saw in the month of January was that investor sentiment was largely positive, and not just from foreigners alone, but also from not just from locals alone, but from foreign investors. You recall that over the last 3 to 4 years, local institutionals and local retailers have been the one moving and driving the market. However, we're beginning to see foreign interests. In January, we saw them, they became more prevalent in the market. They took advantage of the cheap valuation in the market, and we saw them that we saw increased participation from them. So in summary, the market was excited generally about the companies that were in the exchange, both from the foreign leg and from the local leg.
All right, now let's take a look at the sector performance, which of course was mixed. We saw the banking sector take the lead with an impressive 9.47% gain. Insurance shared 1%. And to think that insurance actually started the year on a very strong footing. Talk to us about factors that sort of fueled the sentiment these two sectors enjoyed.
Okay, so I will start from the insurance sector, right? The sentiment that we saw in the insurance sector started towards the ending of last year. And that was around the news, conversations around the recapitalization of the sector. We will recall that news came into the market at the last quarter of the year, and that supported sentiment. That sentiment also flowed into the market at the earlier part of 2025. But notwithstanding, towards some weeks into the new year, we began to see investors take profit, right? So it's not because valuations are not good in those sectors, or maybe because investors have gotten to the maximum value. It's just a case of them taking profit. Some of them are exiting at over 50, 60, 70% profit. So clearly, it was profit-taking activities that led to that slowdown that we saw, or that contraction that we saw in the insurance sector. For the banks, it's a combination of a few things. One, when the market sees, or in periods where foreign investors are interested in the market, they mostly consider banks. That's number one. So because they mostly consider banks, or banks is a preferred destination for them, or one of the preferred destinations for them, we saw that supported the banking sentiment. Secondly was the improved liquidity, right? That liquidity means that we could have investors who want to take a major position in the market, who have been struggling to get in all the while, or who are perhaps want a large share, but they've not been able to get it in the market, being able to get it in the market now, especially post the right issue that was done by the banks. So that also excited a bit of activities. And third, when you look at banking valuation on a price to book, and you compare it to other African peers or other emerging markets peers, Nigeria's banks are relatively cheap. We think that also supported sentiment in that space. So these three factors, was what drove the banking sector, while profit-taking activities was what led to the contraction in the insurance space.
All right, let's come to the industrial goods now. It fell by 8.51%, and that was largely due to Dangote Cement's 70% decline. What caused the slump, and should investors be concerned about the outlook?
Okay. So it's good to provide two contexts here, right? Why the sector contracted and what to look at going forward. Number one, you recall that early last year, Dangote's share price surged materially, close to 800 at a point. that was because we saw Otedola bought into that shares. Now, that movement that we saw was not necessarily driven by fundamentals. It was driven by Otedola that bought the stock. Now, because the shares price rallied materially, it became overvalued, in our own view, based on our valuation. So what we saw was that the market was correcting itself back to the level where they think that Dangote should be trading. So that was why we saw that material decline that we saw in Danksem. Now, does it mean that there's no value again in Danksem, or buying Danksem is a value trap? No, we think that Danksem is a solid company, because if you look at the fact that the government is aggressive on infrastructural projects, right, it gives a sense that likes maybe like WAPCO and the likes, right? So it's clear that there is still going to be opportunity in the cement space. It was just a recorrection of Dangote cement, which was propped up by Otedola, that led to that massive decline in Danksem, which led to massive decline in construction sector. But going forward, I think at current levels, Danksem appears to be around the levels of our own valuation. So investors might begin to rethink the acquisition in Danksem, and they might also begin to look at the entire sector, with broader spectrum. For us, we like WAPCO, given the fact that WAPCO has been able to cut off or deleverage materially, and also the fact that the company is focusing on efficiency rather than expanding capacity. So we like WAPCO, we like Danksem still, right, because the prices have now come back to our valuation levels. And then we like the sector generally, given the fact that government is aggressive on construction and industrial activities.
I mean, that's quite interesting. I would have said we should talk about the oil and gas index, which dipped by 1.58%. But of course, I'm also thinking maybe we need to also discuss some of the catalysts you see shaping the markets moving forward, because we're pressed for time. I don't know if you can do both.
Okay, so going forward, in terms of what we think will drive the market, I think that we need to watch the oil palm sector, right? That's Presco and Okomu. So Presco recently released its results, and on that result, we saw the consolidation of the Ghana business that was acquired, right? It's a very good one, because that business earned more than its 40 to 50% of its earnings in dollars, which means that it's good for Presco going forward. Maybe if you see Naira appreciate, they might report FX gain from that front, or even if there is a depreciation, they are unlikely to report FX losses. So clearly, it's a good one going forward. The sector generally is going to be profitable. Presco is very aggressive on expansion. They're also doing acquisitions. For Okomu, we don't think that there is much left go for Okomu in terms of expansion. But from given the fact that global CPU prices are pretty much elevated, it's going to certainly benefit both Okomu and Presco. But in our own view, we think that Presco will do well. It's a premium compared to Okomu. Aside from that, we like the oil and gas space. We think that even though Seplat has been on full bid for a while now, we think that there is still more opportunities in Seplat, especially once we see the consolidation of the MPNU deal or assets that was recently acquired. Take, for example, the mobile asset, that's the MPNU. Oil production capacity is around $75 per barrel, $75,000 per barrel. That's bigger than Seplat's current production capacity of around 45,000 barrels per day. So clearly, we think that there's still more room for the oil and gas space. For the consumers, they've been badly beaten over the last 2 years. That's because of FX losses, because that has wiped out bottom line, and for some company that has wiped out the capital. We think that FX is going to be relatively stable this year, which is
All right, Mr. Baboye, if you can hear me, I'd like you to just wrap up on that so we can close.
Okay, yeah, so that's basically.
All right, then. Thank you so much for coming on the show and for sharing with us. I mean, a lot of persons are sort of optimistic regarding consumer goods. They're saying with the stability we're seeing in the foreign exchange market, it is hoped that, they're going to turn profits. A lot of them are already beginning to do that, and it's hoped that that will also support the sector. Thank you so much for your time and your thoughts on Business Edge today.